All right, it's still Jackson Hole week, but after today, I promise I'll stop with the whole hat thing. I'm just getting amped up for tomorrow. Of course, we're going to hear from Jerome Powell bright and early tomorrow morning, and he could roil markets even further. But in tonight's video, I wanted to talk about what a dramatic day today was in the market. Something about August 24th. Remember, today is the 8-year anniversary of the mini flash crash back in 2015. So we'll talk a little bit about that in tonight's video. But the story of the day, without a doubt, was NVIDIA and the enthusiasm that we sensed out of NVIDIA in the after-hours session yesterday that led into a burst of buying activity that gapped the market up to start the day today, quickly faded, and we basically closed at the lows of all the major market indices out there. Not a good look if you want to be bullish. So we'll go through all of that and see what it means for our postures. We'll look at a lot of macro conditions. We'll look at a lot of sectors. We'll take a look at our factor selector tool as well. And then we'll get into our trade application example. And many of you know that on days when the market is down by more than 1%, I like to take advantage of that added volatility by looking for a dividend growth investment that I can sell puts on to generate some income. So in tonight's video, I'll show you a good example of that where a stock has an oversold weekly cluster. It's already trading in the blue attractive zone of the dividend stair step chart and could very well provide a nice income booster for us moving forward. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 24th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. We'll also tell you which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. And after today's heavy selling, I imagine we're going to have probably over 100 oversold clusters in tonight's email, so stay tuned to that. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me at my handle, at Brandon Van Zee, and we really appreciate those of you that click like and repost on these market outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us, and it was a doozy of a day. Now keep in mind, a little context probably is helpful here. As we put our heads on our pillows collectively last night, there was a lot of assumptions coming into trading here on Thursday morning because we witnessed what a lot of people would call a smashing success in terms of NVIDIA's response, or at least their report of their earnings in the after-hours session last night. And at one point, NVIDIA was up nearly 10% in the after-hours trading last night. Remember, NVIDIA is not a small player anymore. They are a $1 trillion plus type of a company. And when you're $1 trillion and you tack on 10%, that's $100 billion that's just being created out of thin air. And that's the equivalent of something like a BlackRock, just to put that into perspective. That was being added to NVIDIA at one point last night. Fast forward to this morning, things still looked pretty reasonable. Most of you that saw my 9 at 9 this morning at about a half an hour before the market opened know that NVIDIA was one of the leading players in the pre-market session as well. It wasn't nearly as robust as what we saw last night, but still we were talking about somewhere between, let's say, 5 and 8% is kind of where it was up this morning before the bell. And then, of course, they ring the bell and they're off to the races. Everybody's enthusiastic about the AI theme. And then, the reality of our current situation sets in. And we remind ourselves that we're in a little bit of a sell-off here ever since the beginning of August. And a lot of folks use that pop this morning as an opportunity to take some profits that have been so few and far between here this month. And as you can see, the end result is that NVIDIA, after being up 10% yesterday after hours, actually closed the normal session today at 0.1% higher. That's it. Basically call it flat. Today, by the way, was also somewhat of a noteworthy day. Some of you might have seen my post. Let me see if I can find it here real quick. It would have been one of my earlier ones this morning. There it is. Today was kind of an interesting day because it was the 8-year anniversary of the mini flash crash on August 24th of 2015. Not that that probably had any impact on trading today, more of a coincidence than anything, but we had a fair amount of time spent talking about this in my question and answer session today. And for those of you that might be newer to the markets who might not have been trading back in 2015, this was a truly extraordinary day where Home Depot, just as one random example, was down 20% at the open that day. Yes, you heard me correctly. 1/5 of Home Depot's value disappeared, even though there was no headlines on Home Depot that morning. And JP Morgan, same thing. 1/5 of its value just disappeared. Now, by the end of the day, most of those losses were recovered, but that was truly an extraordinary day, and that happened to be exactly 8 years ago. So, I don't know if that was a huge coincidence or not, but maybe, just maybe, somewhere in the back of our minds, we prefer to sell on August 24th. You can see what the end result is here today. After the quick pop out of NVIDIA this morning, markets basically spent the rest of the day selling off, and it was fairly aggressive in terms of all the different corners of the market that it was impacting. You'll notice here that some of the brightest red on the heat map is surrounding NVIDIA. And so it was almost like NVIDIA kind of sucked the air out of the room. That was another one of my tweets that I got a kick out of here today. This one right here where I say this is the heat map of the all-important technology, communications, and discretionary sector. And here you have this gal with her hand right on the pickup truck handle there, and is about ready to watch AMD and Apple and Microsoft and Google and all the rest of the tech players all tumbling out and getting pretty roughed up there. And that is effectively what happened. NVIDIA managed to stay in the truck, but everything else fell out. And you can see it was not easy in some of the cases. Just a quick run through of the Magnificent Seven. Apple really took it on the chin, down 2.6% here today. Microsoft wasn't too far behind, down 2.15%. Remember, those are the two most important companies in the market, both of them down over 2%. So about twice as bad of selling in those two names as what we saw in the overall market. That's not a great sign. In addition to that, our other Magnificent Seven players, Alphabet was down over 2% as well. Meta was down 2.5%. Amazon was down 2.7%, and then Tesla was the worst of the seven, down 2.88%. So of the Magnificent Seven, the only one that was not down at least 2% today was NVIDIA, which just barely hung on to the slimmest of gains. In terms of its direct competitors, remember a lot of the Magnificent Seven doesn't compete directly against NVIDIA. That's going to be more of your semiconductor players. And you can see as I'm hovering my mouse over this here, what a lot of those results were, and it wasn't good. Broadcom down 2.5%. AMD down nearly 7% today. Texas Instruments down 2.5%. Intel was down 4%. Qualcomm down 2.5%. Analog Devices down 2%, Micron down 2%, NXP Semiconductor down 3.5%, Microchip down 3.5%, On Semiconductor 3%, Manpower, actually that's Monolithic Power Systems, sorry, down 6%, Skyworks down 2.8%, and then Qorvo down 2.5%. That is some extreme selling directly within the semiconductors industry in the S&P 500. And again, the only one that managed to close in the green was NVIDIA, and it did not close higher by 10%. It closed higher by 0.10%. And so quite an extraordinary set of results here when it was all said and done. You did have some of the semiconductor equipment players also struggling here today. Applied Materials down 3.7%. Lam Research, which, by the way, had a very nifty, I think it was a 16% dividend increase announcement today. That didn't really stop the bleeding. They were still down 3.2% today. KLA 10 core down 3.6%. And then TER was down 3% as well. So whether you were a pure semiconductor player or a semiconductor manufacturer with equipment, you were in the house of pain here today, everything outside of NVIDIA. In terms of other heavier selling, we saw that Netflix and Disney also took it on the chin today. Boy, Disney has been absolute dumpster fire for quite some time. They were down another 4% today. We're now talking about levels. I think they said on TV earlier today that it was levels not seen since like 2014 or something like that. So we're talking about Disney now trading well below where they were at the worst part of the COVID crisis in 2020. Think about that for a second. If you think about a company that would have been directly impacted by a global health pandemic, by keeping people out of their theme parks and all that kind of stuff, and the chaos that ensued with the trading at that time, Disney is now trading lower than where it was at that moment in time. I guess that goes to show you how bad the streaming business has become. And Netflix didn't fare any better. They were down 4.8% today. Of course, they've held up much better than Disney over the years. Nonetheless, today, a challenging day for Netflix shareholders. So those are some of your heavier selling areas. We did have a company-specific news item there with Boeing. They're back in the news for the wrong reasons with airplanes and parts not necessarily holding up to the rigorous demands of regulators. And so they were down 5% today. That didn't help the Dow Jones out at all. We saw that Medtronic had a tough day, down 3%. Dexcom down 3% as well. We had Dollar General down 3.5%, and then Dollar Tree down 13% today. I think they had their earnings. Some of you might have seen my post on Twitter here a little bit earlier saying that I've been shopping at the Dollar Tree here and there over the summer and finding some interesting deals compared to what some of those products are selling for on Amazon. Well, that didn't really help their cause today. As you can see, shareholders dumped the stock, and I think it was actually the worst performing stock in the entire S&P 500. Usually you wouldn't think that a dollar store retailer would have such a dramatic result there, but they were down 13% today. Ouch. Copart struggled today. They were down about 5%. Remember, that was the company that I mentioned in Tuesday's video that had their stock split here this week. Had a lot of the travel-related names struggling today. Remember, they were holding up a bit better on Tuesday. Not so today. Royal Caribbean down 3%. Booking down 2%. Carnival down 3%. So you can see the selling was really bleeding over to a wide variety of areas. There really wasn't a whole lot of areas where you could avoid the selling. You had a little bit of a patch of some of these insurance companies that did okay over here. Aflac, Prudential, some of MetLife, some of those companies were up a little bit. You had a little bit of buying interest in some select corners of the healthcare world. So like the medical distribution companies were up just a touch today. We had a few of these healthcare plans up, although it wasn't a clean sweep there, but at least a little bit of green kind of creeping in there. And that's kind of about it. Really, it's kind of, you saw MO, by the way, they raised their dividend today as well, just like Lam Research did, about 4 or 5%. Altria, ticker symbol MO, is now yielding 9%. And of course, that's the company behind the Marlboro cigarette here in the United States. But they managed to close in the green today, probably as a result of some of that dividend increase news that hit the wires there today. So all in all, tough sledding out there for sure. And remember, heading into Jackson Hole tomorrow, things feel a little precarious, right? Remember last year and in prior years when we've had selling, a lot of times Fridays are not necessarily the best days either. It kind of gives you the impression that there's, people that are liquidating their portfolios as we head into the weekend because they don't want to wake up on Monday morning with even more bad news. I don't know if we're necessarily to that extreme type of a market right now, but, if things really pick up with selling upon Jerome Powell's comments tomorrow morning in Jackson Hole, all bets are off. So we will see what that means. But we've already known here for several weeks at this point that there's been some pretty decent selling out there, and most of the markets are already trading below their moving averages. So we already know we're in a precarious place. It's just a matter of whether the market wants to kind of take that even further and use it as a further catalyst here tomorrow. So we'll find out soon enough. Let's take a look here at the specific breadth numbers now in the S&P 500 today. You can see that just 91 stocks closed in the green here today. So that's only about 18% of the components within the market closing in the green. So, over 80%, 82% of the stock market was down today. And that makes sense given what we just saw there a moment ago on the heat map. That was an overwhelming red type of a day there, right? This is a washout type of a day. Not necessarily to mean that this was it and now we can go up, just meaning that this was a wholesale type of a selling day where you didn't really have an opportunity to hide out in too many corners and avoid the shrapnel that was coming at you. All right, let's get into our normal charts now. And remember that typically when we have at least a 1% move, either up or down, I like to start our charts with this one right here, chart 6D, for those of you that are premium members following along at home. And the reason I like to do that is because it gives you a kind of a more interesting visual of how much or how little volatility we've been having in any given moment in time. And remember how you read this kind of in the middle here, this horizontal indicator, is there's a zero line that is in the black color. It's kind of where my mouse is right there. And then there's a blue line on top and a blue line on the bottom. And as you can see from the label, the blue line is a 1% move. The orange line, if we ever made it there, would be a 2% move, and then the pink line would be a 3% move. We haven't had much in the way of 2 and 3% moves lately, but today was a rare day where we had a 1% move. Market, as you can see, the S&P 500 at least was down 1.35% today. You can see what that looks like here on the chart. It kind of matches what we experienced here on this day. I guess that would have been August 2nd, and on that day, we were down 1.38%, so nearly identical to the 1.35% selling that we had here today. And this is now the third day in the month of August where we have had a 1% pullback. And remember, that had been a missing feature to this market earlier this year. In other words, take a look at this blue line that I'm kind of circling with my mouse here, and then move your cursor or my cursor to the left, and you'll see that prior to this month, the last time we had a 1% sell-off, we'd have to go all the way back to May 23rd. Remember, we were talking about that for a while, how we were approaching some historical records in terms of how many days without a 1% pullback, and eventually something's got to give, right? That type of behavior cannot last forever. It's just not the nature of things. Markets are cyclical. We need buying and selling, not just buying day after day after day. So when that gets rectified and that gets corrected, it usually does it in a more violent fashion. And that's kind of what we've been experiencing here, a little bit more so in the month of August. Again, we went a few months without a single 1% pullback, and now we've had 3 1% pullbacks in just about 3 weeks. So they're starting to stack up here. Now, before we make too much of that, let's remind ourselves where we were just a year ago. This is a 1-year chart, so all the way over here on the left-hand side is what you will see was happening last fall, and we were having a ton of 1% down days. I mean, it felt like almost every single day that the market was down, it was down at least 1%. And we had lots of days where we were down 2%. We even had 2 days that we were down 3%, back here on August 26th, and then here on September 13th. So, while this has felt more uncomfortable here, and admittedly, I think it's felt a little bit more uncomfortable to me as well, even more so than some of you, probably because as a dividend growth investor, my stocks have been getting hit worse than the market's averages at large, or at least that's my impression of things, because we do have a lot of interest rate sensitive types of stocks that are just getting punched in the gut right now. So I'm suffering a little bit more of a brunt of that right now than even I was a year ago. A year ago, I was like, maybe I'm getting through this okay, while everybody else is getting hit. Well, fast forward to where we're at right now, and it's exact opposite. It's kind of a role reversal there. So kind of depends on what corners of the market that you're hanging out at right now. But if you're just more of a broad market generalist, like with your 401k going into an S&P 500 index fund, this, what we've experienced here recently, is worth putting up with if this is what led up to the selling. In other words, nice consistent buying for months and months and months. Is it worth 1% pullback days to get that? Absolutely it is. So it's not to say that this is the end. Maybe this is just the beginning. Maybe we're going to have a terrible rest of the year, right? We'll never know for certain because the future is unknowable. But what we know right now is that it has been still to this point a good year for the market if you're looking at it through the lens of the S&P 500. You'll notice here that the VIX was up today. No surprise there, right? That most of you are aware by now that the VIX is kind of inversely correlated to the market more times than not. So with this little pop higher in this purple line down below, that tells us that the VIX has gone up to 17. If you want to see what that kind of looks like up above, I can just type in the VIX there and then show you with the price action up above here what that looked like. So again, we're going to get used to seeing this pattern when we get over to our main charts here in just a moment. But today was one of those engulfing types of days. Now we're going to see a lot of bearish engulfing candles here in just a moment. But remember, when the VIX acts inversely to the rest of the market, it was actually a bullish engulfing candle for the VIX today. In other words, we gapped down on the VIX and we spent the rest of the day seeing that fear index rising, and it fully engulfed yesterday's candle. So pretty dramatic movement there. While the reading of the VIX right now at 17.2 is not going to be in the Guinness Book of World Records or anything like that. It's kind of how we got to 17.2 that was most interesting. Again, starting with a gap down and spending the rest of the day going up. But to be fair, we're still lower on the VIX right now than we were just a week ago. So we can't get too wound up about this. Perhaps tomorrow we can, right? We'll see if we have some sort of a major 2 or 3% sell-off day in the market based upon Jackson Hole comments, then you'll probably see this VIX get back up there towards 20. But right now, the VIX down here at 17 is half of what it was here on September 28th of last year. Just less than a year ago. I think we're sometimes short-term oriented with our memories in the markets. But less than a year ago, we literally had a VIX that was double where the VIX is at this moment in time. So, and we survived that, right? So if we survive that, we can survive this. I guess that's the good news. It doesn't feel all that pleasant from time to time, but you got to do your best to protect your accounts and hopefully be educated about the decisions you're making within your accounts and live to fight another day. Not every day will be puppy dogs and roses. There's going to be plenty of days where the market is going to offer up a few challenges to you. But it's important not to give up on the market. Remember, in the long term, the stock market is a wealth generating machine. And if you don't believe me, all you have to do is pull up an all-time chart of the S&P 500 and just stare at that for a while and remind yourselves of the agony and the pain that so many other investors have gone through in previous decades. And yet what we ended up with was more all-time highs after more all-time highs. So this too shall pass, as the saying goes. We'll get through it, even if it is uncomfortable in the short term. All right, let's go ahead and take a look here at our main charts now. This is chart 4B for those of you that are following along at home. And one very interesting thing happened today, given the results. I would not have expected this before seeing it with my own eyes, but we actually saw the S&P 500's posture go from strongly bearish yesterday to weakly bullish today. Yes, you heard that correctly. I would not have guessed it myself. And I don't know how long it's going to last, so don't get used to it. If there's another day of selling tomorrow, I have a feeling that it will basically be a head fake type of a day, similar to over here. We had one day of bearish posture before going right back into bullish posture, or maybe something like this one over here on the Dow, where it went to a bullish posture for one day and immediately went to bearish posture the next day. That could easily happen on the S&P 500 tomorrow if there's any sort of selling whatsoever. Remember, the way that this background color of the chart is getting plotted, it's using this green intermediate line on the market forecast technical indicator. And when that green line emerges out of the lower reversal zone, it will then plot that background color light green as it did today. But remember, the lower reversal zone on the market forecast technical indicator is at 20. You can see in the label right here that the green intermediate line is at 21. So in other words, we are just barely above the low reversal zone by the slimmest of margins. And if we get any sort of selling tomorrow, there is a high likelihood we go into the weekend right back to this dark pink color background, with today being just a random fluke in the grand scheme of things. So be prepared for that. Now, if whatever Jerome Powell says tomorrow in Jackson Hole is appreciated by the market and the markets rocket, then maybe this was a sign that it's telling us that, hey, there is a little bit of bullishness entering the system. And basically the way that's operating is it's measuring back over these other candles here and kind of acknowledging that we've had a decent bounce off of the lows from a week ago. But today surely poured put a cold wet blanket on that whole situation. And particularly uncomfortable is the fact that we are below that falling 30-day moving average, right? If that had happened when we were still above the moving average, then I think I'd be looking at that with a little bit more optimism. But at this point, I have to make the assumption that if the 30-day moving average effectively points us in the direction of the path of least resistance, that moving average is now slumping over, meaning that the path of least resistance currently is now back down to the downside. So you've got to tread a little bit more cautiously in that type of an environment. And going back to what I was mentioning before when we were talking about the VIX, here's the opposite of that, where I was talking about those bearish engulfing candles. Take a look at today's candle on the S&P 500. You started the day with a gap up due to NVIDIA and enthusiasm around AI, and then you spent the entirety of the rest of the day selling off and basically closed at the lows of the session. I mean, you were within basically a point of the lows. You can't even hardly see it with your naked eye there. So that's not a great sign, because remember, it gives you the impression that if the stock market were going to be open for a couple more hours than it normally was, there probably would have been even heavier selling. It was kind of the idea of being saved by the bell, right? They had to put the sellers to bed here, so to speak, for a bit of time before we get up and at it again tomorrow morning. So not a great look for the market here all of a sudden. We did have that bearish engulfing candle. That's more of a bearish feature, obviously, and we closed near the lows of today's session. We're below that falling 30-day moving average. We fell by more than 1% on a day when a lot of people felt like we were going to have a really big up day. So it really kind of had an emotional impact on the market today, I think, as well, because everybody was really excited as we got moving here this morning. And then to have that huge disappointment, to see all of those gains go away, that does something to the psychology of the market there as well. So yes, it's true. We have a tiny little green shoot there in the form of a weekly bullish intermediate posture. But like I mentioned before, I wouldn't hold my breath too long on that one, because it could easily go away as soon as tomorrow. In terms of the other indices, so I mentioned the S&P 500 was down 1.35% today. The Dow was the best performer today, if you could call it that, at least on a relative basis, but even it was down over 1% today. It was down 1.08%. And you can see that what it did to the chart is what I mentioned on Tuesday was a high likelihood, which was that the Dow would likely end up joining the other three indices with that red moving average. Right, on Tuesday when I was with you, they were the only one that had the yellow moving average, and odds are higher when 3 out of the 4 are doing one thing that the other one goes towards those other 3, right? That's just the nature of things, and that ultimately was proven to be the case here today, as the Dow also, as you can see, closed at the lows of the session, or at least very, very close to them. And so we now have a red moving average combined with a dark pink background telling us that we continue to have a strongly bearish posture on the Dow, and we're almost ready to enter into the lower reversal zone for the first time on the Dow. Remember, the Dow has been the leader, and even today you can still say that. You can say that even though it was down 1.08%, that was the best performer of today's 4 major charts here. But it's the only one out of these 4 charts that has not yet been in the lower reversal zone here in this last month pullback that we've experienced. The last time the Dow was in the lower reversal zone was back here at the end of May, beginning of June. So it looks like that could happen as soon as tomorrow as well. On the 2 charts down below, you'll notice that the NASDAQ, similar to the S&P 500, does have that light green background color because that green line has emerged out of the lower reversal zone, and we'll see if it has the gumption to be able to make a move off of that, but I have my doubts. Now keep in mind, technically, both the S&P 500 and the NASDAQ composite would have what's known as a bullish intermediate confirmation signal, because we have a bullish intermediate posture. That green line is considered to be in bullish territory at the moment, combined with the red line in the lower reversal zone. But also keep in mind what we've mentioned countless times over the years, that while the signal exists, it gets somewhat nullified by the fact that the red line is at an extreme reading, and that is the case for both of these charts. What we identify as the extreme reading on the red momentum line is 5 or below. Sounds like that discount retailer there, 5 below. It's an easy one to remember perhaps for that reason. But that red line there, if it's at 5.00 or less, we would identify that as an extreme reading. And you can see that both of these are so low. They're actually not just below 5.0, they're below 1.0. Remember, this does not go below 0 at all. So when we're talking about 0.22 here, like we see on the NASDAQ Composites red line, that's about as low as you will ever find that line. And it goes to show that the selling in the short term is extreme, and therefore you better tread cautiously there, because sometimes that's the stock market, telling you that you need to respect the fact that the sellers are dominating the market activity at the moment. So it would be harder to be brave in this environment knowing that. So, just be aware that yes, bullish intermediate confirmation signals, but these are far from what we would call ideal setups here at the moment. In terms of the Russell 2000, by the way, the NASDAQ was the worst performer today. It was down 1.87%. And then the Russell 2000 was down 1.27%. So it was kind of the second best on a relative basis there today. But still, same kind of features here where you've got, basically an entire day's worth of selling closing near the lows of the session here, obviously below the falling 30-day moving average. And it continues to have a strongly bearish posture with that green line in the lower reversal zone right there. So not a good looking set of charts here. Despite some tiny little green shoots here and there, this is not what you want to see if you want to be bullish in the markets. But maybe Jerome Powell pulls a rabbit out of his hat tomorrow. We shall see. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. Remember, they take David and I an awful lot of time and effort to put into it and sacrifice away from our families and other, business projects that we should be doing and personal projects and things like that. So if you appreciate the effort, we ask one simple request out of you. Click like for us there on Twitter /X. And as I always say, as long as we're up and over 100 likes by the time I'm scheduled to do the video the next time around, I'll be more than happy to offer you up a full hour's worth of this free presentation. On the other hand, if you think that these hour-long videos get a little bit too lengthy for you, or you just think it's too difficult to click like, then don't click like. And if we're under 100 likes, then the next time I'm scheduled to do the video, which in this case the next time will be Tuesday for me, then I'll just plan on keeping it nice and short with a 15-minute variety of the video. But like some of the folks were saying in the question and answer session that I taught here earlier today with my premium members, it's nice that I was able to do the video here today because it ended up being a 1% sell-off day. And many of you know that when we have a 1% sell-off day, I go out of my way to look for sold put candidates on dividend growth stocks that I think look somewhat interesting, and therefore, I can have the opportunity to kind of explain those trades a little bit more with these hour-long presentations, and I'm not able to get into those details in the 15-minute variety there. So in the end, we appreciate all of you, but we really, really appreciate those of you that are willing to take the extra 5 seconds out of your day to support us there on social media. Let's do some shout-outs here to some of our favorites. Thank you to Julie, and thank you to Dave, and to Terry, and to Brandon, and to Paul, and Dave, and Linda, and Paul, and Ann, and Paul, lots of Pauls, and Nick, and Ken, and Craig, and William, and H. Battelle, and Rick, and Austin, and Robert, and Richie, and Judy, and Dave, and Bob, Sonia, Ken, Brian, Cryptuck, and Dennis, Eugene, El Zhao, and Ron, and Asaf, and Jean, and Nina, Prickly Trader, Dave, Sandeep, Christy, Oz Trader. The list goes on and on and on. I can't get to all of you, just soak up too much time, but my hope is that you hear your name rattled off every so often for those of you that loyally support us there in the videos. Also, earlier today, as I mentioned, I taught my 3.5 hour long question and answer session. So if you are a premium member of Market Scholars, I would invite you to check out the recording. Remember, with those particular classes, I teach mine on Thursday morning. David teaches his on Saturday morning. We do timestamp them for you, so that way you can fast forward directly to whatever answer that you want to hear. But we had a conversation today about the flash crash anniversary and kind of a little trip down memory lane to where we all were back in 2015 on this day, and some of the trades that we got executed for our class portfolio on that particular day. We also had a conversation here today about Kellogg as a dividend growth investing candidate. We had a conversation about UGI, which is a utility stock that's been just pummeled here lately, like a lot of utility stocks. We had a question about PNC Bank as a dividend growth investing candidate. We had a question about, Charles Schwab and some of the difficulties their firm seems to be going through here more recently, and whether we should be worried if we have our assets with them or not, or in some cases still with TD Ameritrade that'll eventually get transferred to Schwab. We also had a question about how to think about dividend growth investing versus high yield investing if you're a 70-year-old with a life expectancy into your 80s and 90s. We had a question about Bristol Myers Squibb as a dividend growth investing candidate. We had a question about how to interpret Sempra Energy with their recent stock split using the dividend stair-step chart. We had a question about some of the lesser known names out there as well, like NNN, which is a REIT, SWK, which is of course a tool company. We had a telecom company. We had a couple of small financials. We had a tobacco company and a utility company there to end our conversation today. So lots of good stuff as always, jam-packed into those 3.5 hours there. So if you're looking for additional content over the weekend, feel free to check that out there. Remember, David should have taught his portfolio management with ETFs class today as well, and I'm sure he's got his recording posted there for you to check out as well. All right, let's go ahead and take a look now at our factor selector tool. Remember, we use this in my Wednesday morning swing trading class, so it's a couple days old by now, but still can give us a general lay of the land as far as what's been going on here from a factor rotation perspective more recently. We did have quite a bit of change on a week-over-week basis. We did see that quality made its way back up to the top slot there. Now, after today, I don't know if that would still be the case, because remember, quality is driven very much by Apple and Microsoft here at the moment. And since those two did more poorly than the market in general today, it's possible that by the time we gather back together in the swing trading class next Wednesday morning, it's possible that quality falls back out of the number one position. So we'll keep our eye on that, but at least for this moment in time, they were back up to that number one position. And then on the downside, we had low size in the bottom slot there for the second straight week. We've been seeing a lot more difficulties with those smaller banks here recently, and I think that's who we can kind of place the blame on within that particular factor. You can kind of see the rest of them stacked up there in the middle. Momentum at number 2, value fell down to number 3, low volatility went up to number 4, and then dividend yield is at number 5. All right, let's go ahead and now pop back on over here to the main part of the Thinkorswim platform, and let's do some 12 grid analysis. starting with chart 5A. Now remember, this will be our asset class 12 grid, and this will kind of look at a number of different things, including currencies and bonds and foreign stocks and everything in between. So it's rare to find like a clean sweep type of a day with these background colors all green or all pink, right? You could see that a little bit more often with the sector 12 grid, but with this one you hardly would ever see it, because in some cases like bonds and interest rates are going to work inversely from one another anyway. So let's get started with the two bottom corners, as we often do when I go through this part of the presentation. Today we saw interest rates rising, not tremendously, but still giving you that kind of stubborn feeling that they just don't really want to go down dramatically. And you can see that the 10-year Treasury yield closed at 4.23% today, just a few basis points off of multi-year highs. Remember, we're talking about going back to like 2007 was the last time we had interest rates this high. So this is still a very strong chart here and remains a key headwind in major portions of the stock market, including all those interest rate sensitive areas. Now again, tomorrow Jerome Powell is going to be speaking at the Jackson Hole Summit, and he could say some things that will roil the interest rate markets, either good or bad. So this really pretty looking chart right here tomorrow could be disrupted, and I'm sure David will bring that up with you when he does his presentation here over the weekend for you guys. But I'll definitely be watching what's going on with yields as Jerome Powell is speaking tomorrow morning. Now remember, when interest rates go up, as they did today, typically bond prices go down, and that is effectively what we found. TLT was down 0.66% today. You can see it remains with a strongly bearish posture, still below that falling 30-day moving average. You did have a whole bunch of oversold cluster signals. You did have a reversion to the mean type of a move here in the last 2 days, but it's worth questioning whether that's starting to stall out already, right? You'd like to see those types of moves get closer to the moving average, but this thing was so aggressively sold off that this was actually a pretty decent 2-day bounce here, and it may not be able to get up there. That was such a violent move lower that it would require a much above average bounce, and we might not be able to get that out of it. The foreign bonds and high yield bonds look a little bit better than the long-term U.S. Treasuries, perhaps not as much duration risk there, but foreign bonds did close a little bit lower today, just a little bit below break even, but you can see they're trading right on their moving average. So this chart doesn't look nearly as bad as long-term U.S. Treasuries. And then high yield bonds closed lower by 0.55% today. They remain below their falling 30-day moving average. They do have a weekly bullish posture, but again, you kind of have that bearish engulfing type of a feel to high yield bonds here today. Not a great look, all things considered. In the lower left-hand corner now, we have our US dollar. It was also up today, and that also remains a key challenging element of this market. That was a pretty big day out of the US dollar today. It was up 0.8% against a basket of other currencies. If I were to right-click and maximize this, I want to go back a little bit further. Let's go to a 1-year chart, and you can see here that where we closed today, we'd have to go all the way back here to this candle. November of last year was the last time the dollar was strong. Remember, the dollar can be viewed as a bastion of safety of sorts. I know that probably sounds crazy to a lot of people. They think, boy, here in the United States we have so much debt and our government is in shambles and this, that, and the other thing. But despite all of our fleas, we're still the strongest dog at the pound, so to speak. We do find that oftentimes when there's chaotic financial markets around the world and money needs to flee to someplace safe, it does find that US dollar to be of the safer variety out there. Even if it's not the safest thing around, it's safer than many other things, and therefore it starts gathering up some interest. And so anyway, you can see here what this looks like. We have a fairly decent pattern of higher highs and higher lows kind of carved out here on the US dollar since the beginning of the year, and that is providing a bit of headwinds there, because remember, all else being equal, from my perspective, it's easier to have better trades or at least better results in the stock market if the dollar is weak, not strong, because a lot of the stocks that we trade are going to be multinational, where they earn lots of earnings and sales from overseas, and it's going to make it look a lot better when they need to convert those weaker euros into stronger dollars, as one example, when they're reporting their earnings. And so, I for one would prefer to have a weak US dollar, and that is the opposite of what we have right now, and it's part of the reason that not only do you see the U.S. market that has tons of international and multinational companies within it, but it's even worse with the foreign stocks directly. Notice that EFA, so that's the developed foreign stocks, was down 1.37% today. And then EEM, which tracks the emerging markets, of course, yesterday was a big deal with the emerging markets, with Russia in particular, and some of the news we heard with, the Wagner Group and all the chaos around Putin's control and all that kind of stuff. Well, anyway, the EEM remains kind of in the house of pain there, as well as a lot of those BRICS just can't get out of their own way. And so we have strongly bearish postures on both of those foreign stock market categories, and both of them are well below their falling moving averages as well. And if you look at these two charts and then compare it to the US, both of these look worse than the US. And we all know that in the US we're not having a cakewalk right now. It's been difficult for us as well, but it's been even worse overseas, according to what we see here at least. And that's a large part because of what's happening with the US dollar. It just keeps going up. Gold was off a little bit today, but it could have been worse, right? It was only down 0.02%. I'll take it. Remember, I still got an iron condor going on gold right now. It's sitting in the okay territory right now, but if it breaks down below these lows that we saw here last week, all bets are off. I might start squirming a little bit more on my trade. Right now, I'm okay. We go below those lows from last week, and I'm going to have to make some adjustments on my trade perhaps. But right now, gold, I think, had a reasonable day. Sometimes gold can be viewed as a safe haven on a chaotic day, so I wonder if there's an element of that taking place here today with it. So despite a strong dollar where you'd normally find, lower gold prices, you kind of have the safety trade aspect offsetting that negativity with a little positivity and kind of equalizing things there when it was all said and done. You do still have a strongly bearish posture on gold, however. Oil was basically break even today as well, so both gold and oil were pretty much just flat today. In the case of oil, it was just up 0.07%. Here, the chart looks quite a bit better than gold. You're basically sitting at an important area on oil right now at its rising 30-day moving average. You're a hair below it, but it wouldn't take much. I mean, heck, tomorrow this thing could easily be back above that moving average, and if that was the case, that moving average color would go back to green. So oil still has at least some semblance of strength that we're dealing with here at the moment, despite the weekly bearish posture that it shows on the chart at the moment. Bitcoin had a fairly quiet day. It was down 1%, but still kind of clinging to that $26,000 level. Still has that strongly bearish posture and well below that falling moving average. Of course, remember, Bitcoin is kind of like a hypercharged NASDAQ in a way. It's just basically a risk asset, and it's going to move in extreme movements in a lot of cases. So with stocks selling off here more recently, no surprise, Bitcoin's kind of following suit. All right, let's take a look now at the sectors. We're going to take a look here at 5C for those of you following along at home. And here, oddly enough, the tech sector now has the light green background color. Remember, on Tuesday, that was not the case. On Tuesday, when I was with you, all 11 of these sector charts were pink. Today, technology is back to light green, but I'm going to say the same thing I mentioned when we were talking about it with the S&P 500. I wouldn't hold my breath. If there's any selling whatsoever tomorrow, there's a high likelihood that that goes right back to green. Now, what could also happen is energy could go to green. So I'm not saying that none of these sectors deserve to be green. Energy, if it finds a bounce right here, which is entirely possible, I think it deserves to be green. But right now I'm looking at technology saying, I don't know if they really deserve to be green. You got kind of lucky with just the move off the low there more than anything. But that is an ugly candle here today, right? That is an extreme bearish engulfing candle where you had that huge gap up on an important day where everybody's enthusiastic about NVIDIA, which is part of XLK, and then spent the rest of the day selling off and basically closing at the lows. Not a good look. You went up and touched that downtrending 30-day moving average. It was acted as resistance as would have been feared, and sellers stepped in, right? And you saw the same thing here on communications. Went up to that moving average, sellers stepped in, pushed it lower for the rest of the day. So this is an extremely rare day. Not saying it's good or bad, but just telling you this is incredibly uncommon, where the S&P 500 itself has a weekly bullish posture, and only 1 out of 11 sectors has a bullish posture. Now, the only reason that's possible is because technology is the most important of all of the sectors. Remember, the technology sector is basically more important than several of these small sectors combined. You could put like real estate, utilities, materials, and staples together, and it would still not be as important as technology, the one sector. So if there was any of these other sectors that was green and technology was red with the rest of them, we would not have a green S&P 500. So a very random fluke there. And you could go years without seeing this. And the same thing is true on the flip side, right? If you had nothing but bullish or green charts and the S&P 500 was red and there was only one single sector that was red, that would also be equally as strange, and that would also have to be technology. So very rare set of circumstances, but in both cases, I'm not holding my breath. These two could easily be back to red as soon as tomorrow if we get any sort of selling off of the Jerome Powell comments. As you look at the rest of the charts now, you will see that the only sector, the only sector from a market cap weighted perspective at least, that is trading above its 30-day moving average at the moment is energy, just barely, but it is sitting on top of that moving average. And then the only other sector that has a different color than red, of course, other than energy, is healthcare. So healthcare did have a tough day today. It was down 0.87%, so it fared better than the market in general. But you can see what that candle looks like there. It's not a very good looking day for healthcare either, but because we've had some pretty nice movement due to Eli Lilly and some of those companies, we still have that moving average going higher. So notice that the moving average on healthcare is yellow at the moment. It's the only one that is yellow, and energy is the only one that is green. All the rest of them are red. And again, if you believe that the path of least resistance follows the pathway of the moving averages until it doesn't, then that's not a great look for the markets, right? You're basically saying that the path of least resistance on 9 out of these 11 sectors is to the downside here at the moment. And it's hard for the market in general to overcome that type of selling. So we have to kind of be prepared to deal with these more challenging markets here, at least in the immediate future. Remember that August is the worst month historically for the Dow Jones Industrial Average, and it's the second worst month historically for the S&P 500. And if you think we're almost done with August, so we can get that out of the way, slow your roll, because September's not any better. September is also a bad year, or a bad month, I should say, for the markets from a seasonal perspective. So we got to get through this tougher patch at the end of summer and into the beginning of fall. Remember, as we head towards the end of the year, traditionally, we do find that the months of November, December, and January are the strongest months in the market. Now, every year is a little bit different, so you can't bank on that, but historically, that is what we see from a seasonality perspective. So we are weak right now at a time when we would expect to be weak from a seasonal perspective. Therefore, maybe we can expect to become a little stronger as we head towards the end of the year when that seasonality picks up for us there a little bit more as well. So again, do your best just to survive these difficult times. I know that sounds obvious, but for those of you that are newer, you might be a little bit more worked up about this than some of us old school folks that have been doing this for a couple of decades at this point. And you need to hear that type of information, because there are people that will give up. They think, oh, this is too hard for me, I can't do it. And remember, The stock market is a wealth generating machine over the long term. You do not want to give up on it along the way because you have a little bit of a rough patch here or there. We're going through one right now, but we'll survive, right? Capitalism will end up winning the day when it's all said and done, but we have to brace ourselves right now for a bit more challenging period based upon what we're seeing on the charts. So just be prepared for that. All right, let's get into our trade application example now. And I wanted to focus on a consumer staples company in today's trade application example. Remember, consumer staples, I mentioned when I was with you on Tuesday, had a fairly rare oversold cluster signal that day. They actually did catch a bounce yesterday, but then gave all that right back today. So today they're actually trading a little bit lower than where they were on Tuesday when they actually had the oversold cluster signal. So somewhat unique there. It's also worth noting that none of these sector charts right now have oversold cluster signals. So maybe what I had mentioned there earlier at the beginning of the presentation where I expected lots and lots of oversold cluster signals, I haven't actually checked that yet. Usually that's part of my process when I start preparing the emails and all that kind of stuff after I've recorded the video. So maybe I'll need to take that back. Maybe there won't be as many as I'm thinking in my head, because when I'm looking at the sectors right now, none of the sectors from a whole perspective have oversold cluster. I'm sure there's still plenty of them out there, but it might not be nearly as many as I was expecting initially now that I've seen this information here. But it is true that the consumer staples just 2 days ago did have an oversold cluster signal, and that's an area I pay extra close attention to as a dividend growth investor. I own tons and tons of consumer staples and have for a long time. So this has not been a fun period of time for me watching them just roll over as they have. Of course, their dividends are largely safe, and that's what I bank on for the long term. And sometimes, opportunities emerge when difficulties start entering into your favorite sectors out there as well. And maybe that's the case here on this trade example I'm about to show you. So let's go ahead and pull up chart 2A. This is our dividend stair-step chart. You'll hear me refer to it as, and it basically uses the concept of dividend yield theory. I kind of have a slight twist on it as far as how I teach it to my DGI students on Tuesday mornings, where we have an average high yield and an average low yield. So as opposed to just plotting one number in the middle, we're kind of plotting the extremes of those averages. And the way that you would read this chart is you're looking for stocks that are trading in the blue zone. Now this happens to be Pepsi right here, and you can see that despite Pepsi suffering like so many other consumer staples lately, it's still nowhere close to its blue zone here because Pepsi has been a runaway success in recent years. So it would need to sell off harder in order for its dividend yield to get higher. But there are plenty of other companies that are not of the ilk of Pepsi that are trading in the blue zone. And I will show you one such name. It's one that I guess I will dedicate this trade to Leah here, because she apparently inspired me with it here today when she asked me about Kellogg in our question and answer session earlier today. And as we were going through our review of it, I was like, yeah, so this looks kind of interesting, and this looks pretty good here, and this is what you want to see. And, there are plenty of things that we talked about on the negative side of it as well, including some of the weight loss drugs and the messiness of the upcoming spin-offs. So again, if you're a premium member, I would encourage you, if you want a full, like half-hour long presentation of my analysis on this specific company, go and listen to my question and answer session recording earlier today. I actually have to get this trade wrapped up here in the next 5 minutes, so I can't go into that length of detail with these off-the-cuff trade ideas that I present to you here in these free YouTube videos. But for those of you that are looking for additional analysis, I do have that for you in a timely manner, in this case, giving it to you just earlier today. But let's talk it through real quick here, some of the things that will catch my eye with Kellogg. First of all, it's a company that has basically, I think what we found today is that it had 98 years of uninterrupted dividends. That does not mean that it's grown its dividend for 98 years. It's done that for 20 years, but it has gone 98 years without ever eliminating the dividend. That's a powerful statement. That's probably longer than nearly everybody that's listening to this video right now, unless we've got a few of these videos going in the nursing homes out there, or maybe Charlie Munger, right? Just joking, of course. But point is, they have a long, illustrious history history of being very generous with their dividend policy. Now, as you can see, this stock is currently yielding 3.95% and has made its way into the blue zone. And again, what that means is that from a dividend yield theory perspective, this stock is now viewed as an attractive candidate for new long-term money. That's not obviously a recommendation or advice or anything like that. I can't legally give that to you. But in general, the theory suggests that at these yield levels in the past, the stock has been bid up. And in addition to that, why this one in particular caught my eye is it also has an oversold cluster signal here at the moment. By the way, some of you saw me tweeting about Nike here recently. Nike was very close to being our trade application example tonight, but the reason I opted not to do it in the end is because they do have an earnings announcement coming up here at the end of September, and I was looking at the October contracts for these put selling ideas here. So some of you, if you're brave enough to sell the contracts through earnings, you might also want to take a look at Nike because it's approaching that blue line. You could sell the 85 strikes in the month of October and capture at least a 1% return on risk. It also has an oversold cluster signal. So think of this presentation perhaps as a 2-for-1 special. Kellogg and Nike. But back over here to Kellogg, they're in more of a traditional reporting time period. So the next time that they will report their earnings is probably going to be around November 3rd. And so what I did here was I sold the 5750 puts in the month of October, and we were able to get well over 1% return on risk on those. You can see that Kellogg has a payout ratio of just 55%, so there's no risk to the dividend being cut here, at least from my perspective. In fact, you can see the dividend was actually just increased from 59 cents to 60 cents here more recently, so that should suggest that it's a little bit safer, perhaps. And then you can also see that the PE ratio, it's trading at just 14 times earnings right now. Notice down below here, this PE ratio trajectory over the last 10 years shows us at 14 times earnings right here. Really the only other time in the last decade where it was trading cheaper than it is right now was back here in this time period in early 2019. That's when the stock was way down here as well. You can see that a lot of these oversold cluster signals on the weekly candle charts, those are those little green dots that show up on the charts, they've worked nicely in at least the most recent years. Had you been buying Kellogg's right here, it went up for the next several months immediately after that. Had you been buying it right here, it went up for the next several months immediately after that. Had you been buying it right here, it went up, for the several months to a year after that. These ones over here, we wouldn't really care about because they're not happening in the blue zone, right? It's a combination thing. Green dots in the blue zone. Is that an attractive time to be locking down long-term, high quality dividend growth companies? More times than not, it is. Will this time be one? Hard to say, but we'll see if we can have a stake in it there by selling that 5750 put. Remember, I already did this trade, and I send these out via Telegram on our private Telegram channel to all of our premium members before the stock market closes, so that way they can consider it for their own accounts if they want to there as well. But another key thing that I want to stress here in this particular case, first of all, notice that Kellogg was barely down today. So that's a good sign probably as well. It was actually up until about 1 minute before the market closed, and then it closed lower by 2 cents. But again, remember, the market was down over 1% today. So Kellogg was one of the few companies out there that was either at break even or in the green here today. So that's a good sign. Remember, Kellogg is an old school company, probably one of those companies that would benefit if the stock market continued to weaken, because then the expectation of interest rates coming down would be in the marketplace, then supporting some of these interest rate sensitive areas. So it's kind of a steady Eddie type of a company that's out there. But again, I will reiterate what I had mentioned briefly a moment ago. This one will be expected to have some spin-offs taking place with it in coming months. I don't know when the exact date of it is, and some of you might choose to pass on this trade idea if you don't really want kind of a messy or complicated situation from that perspective. So again, I'm not your advisor. You'll have to make that decision for yourself, but I at least figured this was worth a shot here in this case. A company that has a respectable dividend history It has a higher than average yield. It has an oversold cluster signal on the weekly candle chart. It's in the attractive blue zone of the dividend stair-step chart. Its earnings are at one of the highest levels it's ever been at. Its valuation is at one of the lowest levels that it's seen in the last 10 years. So a lot of attractive features to it. Obviously not a guarantee, but you want to kind of stack as many of those attractive features together whenever you come up with your trade ideas. Okay, so that's what I had for you here tonight. If you enjoyed that presentation, I ask one simple request from you. Click like for us there on Twitter/X. Remember, you can do that by going to my timeline. It'll be pinned to the top of my Twitter timeline. Otherwise, if you're on our website right now and watching this video, you can click the little Twitter widget directly below the video that you're watching. If you're on YouTube watching this video directly, go into the description area and you'll find the link to the tweet in question there. And then on our emails that we send all of you, down below on the emails, there's an icon with a little Twitter bird on it still that you can click on that will direct you to the tweet to like as well. So any one of those 4 ways that you find to be the most convenient will get you done there. That goes a long way for both David and I, and we appreciate that. But let's keep our head on a swivel. Tomorrow's Jackson Hole. Let's see how we finish up the week. Take care, everybody. Bye-bye.